Hey everybody, we are going to talk about Boston Omaha Corporation BOC's latest earnings. They just reported their second quarter earnings, always fun to talk about. And I've been asked a lot because I was one of the first people who were writing about this stock. I bought in shortly after the IPO and have held on to it ever since through thick and thin, a lot of thin. But we're going to talk about the latest numbers. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now for free from the Motley Fool. It is the best way to support this work I am doing on YouTube. That link is in the description of this video. But again, it is fool.com/Frankel. Please check it out. So the short version is that there were no giant surprises in this in the second quarter earnings report. Um, about a year ago, one of the co-CEOs of Boston Omaha, Alex Rozek, left the business. That was really unexpected. One of the big positives that's come out is that we now get some insight each quarter into management's thoughts about how the business is doing and what they're focusing on. They now release earnings decks for the first time in the company's history. I mean, it's been going on for a few quarters now, but ever since Adam Peterson was sole CEO. And so we'd actually have a little more insight into what's going on than we did before. I'm going to share my screen. Boston Omaha these days has three major business lines. They say four in their company description, but they're in the process of winding one of them down. So there are three. There is the billboard business, which is Link Media, which is what the slide you see on your screen. There is a broadband business, which they technically break into two. There's an insurance business, and then there is Boston Omaha Asset Management, which is in the middle of being wound down. They had some big plans for Boston Omaha Asset Management. They really just kind of blew up over the past couple of years, for lack of a better term. They were going to build a real estate business. They were going to raise third-party capital to really go after the broadband opportunity. They were going to eventually spin off the real estate holdings as a REIT. That was something that they floated around, and they literally gained no traction, and that business is kind of imploded. But there are three businesses that still exist, as well as some minority investments that are worth mentioning. So we'll start with Link Media, the billboard business, and this is just really just a yawn, in my opinion. I mean, revenue was totally flat year over year, didn't even keep up with inflation, which is kind of disappointing. They you can see right here that they said it was because of reduced advertising spending, which I do buy that. It's a tough environment for advertising, especially remember in the second quarter. That's when the Liberation Day tariff announcements happened. There was a lot of economic uncertainty going on. The market has really rebounded since, but there was a lot of advertising pullback. So I somewhat buy that, but it's still disappointed to see flat year over year. Net income was down significantly. Adjusted EBITDA was down significantly year over year. So not that impressive here. Link, but to be fair, they really haven't put that much effort into Link lately. They haven't acquired any new billboards for a while. Just for example, they digital conversions of billboards has been a priority, but you could see they've only gone up by 5 over the past year. So they really haven't been putting too much effort into this. I'd like to see them try to unlock a little more value from Link going forward. But let's move on to the broadband business. So in the second quarter, and broadband is the area that really frustrates me. And it's because that's where they are putting in the most of their efforts. So you can see fiber passings, which is, when they're building out the new fiber networks and things like that. That's a significant jump year over year. 7,000 customers to 35,000. That's a pretty, they're putting a lot of effort into this. And we keep hearing that it's going to translate into, we're going to see this cash flow start to really materialize. And 2025 was the time when we were supposed to start to see it. It hasn't really came to be so far. Um, Now, to be fair, I wouldn't say that this business is doing poorly. Adjusted EBITDA actually grew pretty significantly year over year right here, almost 17%. Um, and CapEx is still pretty high. They're still putting a lot of money into this. Most of that is related to growth, not maintenance. It's worth pointing out. So again, not terribly disappointed at these results. It's just, but at the same time, there's nothing that just stands out to me and makes me say, wow. And I mentioned they break the broadband division into two segments. The other one is fiber fast homes. These are their fiber passings that are installed into newly built homes. And the idea is that by doing that, the cost of fiber internet is paid through the HOA of the new neighborhood, and it's a guaranteed customer. So the economics make a whole lot of sense. They're putting a lot of money into this. It is not profitable so far, but that's okay at this juncture. You could see just how many more subscribers they had than a year ago, how many more passings they had from a year ago. So it's not a bad business. The losses are narrowing a little bit. Margins are strong. Revenue growth, it's still a very small component of the company's overall revenue, but it's growing at a significant pace and is worth keeping an eye on. I want to see cash flow though. I've been a shareholder. It's been 8 years I've been a shareholder, and it's time that I want to see some cash flow. I'm kind of in show me mode at this point. I know a lot of people who are watching this, even people who are really all in on this business, have only been shareholders for a few years, but I've been here since the beginning, so I'm ready to see some real results here. General Indemnity Group. This is the insurance business, and in my opinion, it's the most impressive, and it's getting the least amount of attention. They're doing a great job of growth. The loss ratio jumped up a little bit. They had a couple of, and that was, but you can see on the side, those are just kind of one-time items. I'm not that concerned about that. Revenue was up 12% year over year. Just if you look, just because of that was based on mostly full-time, one-time items. Looking at the first half of the year, which includes the first quarter, is a little more telling, and you can just see some of these growth numbers. They're really impressive. And I'd like to see them really lean into this business a little bit more at some point. But they're doing a good job of growing the insurance business. The surety insurance market is not a very big one. It's a pretty niche insurance market, but they're doing a good job of growing into it. It's very profitable. That loss rate, even that higher 32% loss ratio, is like unheard of for an insurance business. So surety insurance can be very, very profitable. So they also have, I mentioned, some investments. The big one is Sky Harbor. They own roughly 20% of Sky Harbor, which is a publicly traded company, SKYH, that they helped take public during the SPAC boom of 2021. In my opinion, one of the better companies to come out of the SPAC boom. It's worth significantly more than they put in. I believe they put in right around $100 million altogether, and the value of their investment is currently about 127. And you can see they've cashed out some of it. So it's not been a bad investment. That's really been the best part of the business in recent times. They own a few other smaller ones that all the ones toward the bottom are pretty much being wound down. These are the Boston Omaha asset management businesses that they're getting rid of over time. And they have about $41 million of cash they could use. They did not buy any stock back in the quarter, which is kind of frustrating. But if you see right here, they said it was specifically because of share repurchase blackout periods, which we can get into all that. But essentially, it means they weren't allowed to buy stock during those periods. And last thing I'll show, this is from the earnings release itself. Book value per share is $16.88. As I'm talking, the stock is trading for about $12.50. So my thoughts, nothing spectacular. Insurance is probably the most impressive investment segment, at least in terms of Q2 results. I'm really not impressed with the fiber results so far. That could change, but not yet. It's trading for a roughly 20%, 26% discount to its book value, which is an all-time low. And it's tough to make the argument, no matter what you think of their execution, whatever, just based on the assets they have, it's really tough to make the argument that the business is worth less than the current share price. So my opinion is buyback should be the priority. They're having their annual meeting next week, so hopefully we'll hear a little bit more about it then, now that blackout periods will be over. But I think that should be the all-in priority. Cut your CapEx by a significant amount, especially when it comes to growth in the broadband business, and put that all into buybacks. Be aggressive with it. Set a statement. That should be the priority right now. So one of two things is true. And I'll stop my share real quick. So one of two things has to be true. Either the stock is an incredible value or that book value is not accurate. So if management believes that the stock is actually worth that $16.88 or more a share, which they've said that the book value is lowballing it, If they actually believe that, there's no reason to not be all in on buybacks at this point. I'd love to hear Adam Peterson's thoughts on this. Hopefully we will. I'd love to hear your thoughts on this too. Leave me any comments you have. I'll do my best to respond to each of them. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.